And we also had the SBI chairman, Rajnish Kumar, speaking to my colleague Neha Tyagi after they delivered their stellar Q2 numbers. Let's listen in to what are the factors that have driven the earnings and the outlook.
Throughout the year, yes. Quarter to quarter, not.
For the rest of the year, I mean.
Yeah. So, rest of the year, our estimate is that we will be within the range of 2% fresh slippages.
Okay. So, but what would you say were the reason behind the slippages coming down from 16,000 to about 8,000?
First year, we have to analyze sector by sector. First year, there were slippages in retail book, quite a bit. This year, that has been contained. And first quarter, generally, slippages are higher. But this time, they were unusually higher because of the agri segment.
Okay.
And rest of the segments, our P segment, housing loan, that is book is performing very well.
Sure.
It is always about agri and SME. So all segments, agri, SME, P, the fresh slippages have come down. Corporate slippages also, whatever is our normal baseline rate is there. So they are also in line. And if any time any large account slips, then the number gets distorted during that particular quarter.
So, but as far as provisioning concerns, heightened provision continues. By when do you actually see this things improving on this side?
So it all depends upon the resolution and recovery. But from our side, we have built provisions which are more than what we believe will be the estimated loss.
Okay.
And bank's strategy has been now that we start providing in advance wherever we see that there is a chances of the asset getting classified as NPA, and that is very helpful to the bank, and that's why you're seeing that, for example, our corporate book, the provision coverage ratio is more than 73%, where LGD would not be more than 60%. And that is borne out by the fact that 3 accounts alone, we are sitting on a potential recovery of 17,000 crore. So that kind of cushion has been built in the bank's balance sheet. And that is what I have always maintained, that we will build enough resilience in the balance sheet and P&L so that any abnormal situation for the bank in terms of slippage can be taken care of.
So your thoughts on overall credit growth, and will there be any revision as far as your guidance for this particular year is concerned?
You know, our loan book is very big. So the 12% to 14% is a very reasonable estimate. I have not revised it downwards as yet because I believe that as the capacity utilization and demand for funds increases from the corporates, they will be utilizing their working capital limits and we will be able to achieve that growth.
So could you give us an understanding of the kind of benefit that you will get from the corporate rate tax cut? If you could.
So, no, we will get the benefit. We will move to the new dispensation, and whatever is our DTA or MAT or earnings from gift city, all that as per the new law we will have to pay or pass the necessary accounting entries. So we will do that. We have time till 31st March 20.
Okay.
And ultimately next year onwards there will be a significant benefit to the bank.
So trends as far as retail book and corporate book growth is concerned?
So retail book is growing very well, 18% on an average. Housing loan, SBI has 35% market share. Auto loans, we have 35% market share. Personal loans are doing very well, which are secured by salary cash flows. And corporate, as I said, the term loans, we are seeing the growth. Working capital utilization continues to be low, but I think it will pick up now. October is seeing some pickup.